Hi, I'm Alex Arujo, manager of the M&G Global Listed Infrastructure Strategy. Listed infrastructure is at the core of the solution to many of the world's most important and pressing issues: climate change, energy security, the need for social infrastructure, and an increasingly digital society, to name a few. It's an asset class that is enduring, that is long-term in nature. Well, there are different ways to invest in the asset class, and our particular approach is to invest for growth. And when you invest for growth, we're not investing in bond market equivalents or bond proxies. We're investing in cash flows that grow over time from advantaged physical assets, and in companies that can express that growing cash flow stream through growing dividends so that we can grow the income to our own investors over time. It's very important to consider assets differently within the asset class, because there are some that are more affected by higher interest rates because of high debt levels, for example, or a lack of growth, and those are the kinds of businesses that we actually avoid. We pay particular attention to the balance sheet strength of the businesses that we invest in, and the strategy has consistently shown a lower leverage or a lower balance sheet debt level than a typical benchmark for the asset class over time. And that's because we invest in areas that aren't necessarily represented in the asset class in other strategies, by way of evolving infrastructure in particular, and a number of companies that don't actually have any debt whatsoever. We have to remember that last year was an exceptional year for listed infrastructure as an asset class and for our own strategy. In fact, in a market that was severely impacted, the strategy was able to preserve client capital while also delivering a growing income stream. So in many ways, it's not a surprise that in a market phase that is rewarding other areas of the market, some businesses get left behind and aren't participating as much in the upward momentum of a very different market environment than what we experienced last year. We absolutely embrace these opportunities to invest for the long term. The fund year to date is lagging the broader equity market, which is to be expected in many ways, but outperforming the peer group and the asset class in general. It's quite typical in equity markets for sentiment to overly impact equities that are seen as interest sensitive. There are many infrastructure businesses that are structured as real estate investment trusts, for example, and utility businesses also will tend to be negatively affected by sentiment from time to time. But we do invest in businesses that grow, and we see a long-term opportunity in these businesses that have been negatively affected by interest rate sensitivity. We invest in these businesses for the long term, it's important to remember, but should the Fed pivot to a more accommodative stance, I would expect that there would be a near-term boost for many of these businesses, and we're very well positioned for that, but always keeping in mind the long-term opportunity for these companies that have long-term growth prospects. It's a very exciting area, and everyone's looking for opportunities in artificial intelligence. This video was not generated by AI. I will say that right up front. But the one area that's quite exciting within infrastructure sits within our digital infrastructure exposure, and particularly data centers, because the more that AI expands, the more processing capacity and the more processing power is required, and all of that requires space. We have data center investments with positioning around the world that are seeing a significant investment opportunity to create space for not just AI, but many other digital applications over time. Well, unusually, the market isn't rewarding some of the most exciting long-term opportunities for the strategy, specifically digital infrastructure, which has been held back by perceived interest sensitivity, despite the fact that the long-term growth prospects are very much intact, and the utility sector, where the energy transition and energy security play a critical role in the opportunity set. We cherish these kinds of opportunities. We've seen them many times in the past where overt interest rate related negative sentiment impacts these particular sectors. And we've invested in those areas opportunistically when that's happened, with a typical burst of performance subsequently. We don't always know when that will happen, but historically, that's exactly what we've experienced, and we feel very, very well positioned for the next market phase.